the Market Chronicler.
Good day, welcome to the Market Chronicler's monthly market brief. Before we dive into the detail, let's briefly outline the structure of this market brief. We'll start with South Africa, looking at the two core components that matter most for local investors, the exchange rate through USD SAR and local equities via the JSE All Share Index. From there, we'll step back and place South Africa in a global context. On the global side, we'll look at the US dollar using the dollar index as a reference point, followed by global equity markets, focusing on the US through the S&P 500 in Europe via the Euro Stoxx 50. Finally, we'll cover key global commodities, specifically gold and oil, given their importance for inflation dynamics, risk sentiment, and South Africa's broader terms of trade. The aim is not to forecast, but to provide a clear snapshot of where markets stand, what has driven recent moves, and which forces are most relevant as we move forward. Let's start with the USD-ZAR exchange rate. Over the last 3 months, the rand has strengthened noticeably against the US dollar, moving from the high 17s into the mid-16s, currently around about 16 rand 10 to the dollar. The chart on the slide reflects roughly a 7.5% depreciation in USD-ZAR over this period, meaning the rand has gained ground. This is significant because emerging market currencies like the rand have been under pressure at various points over the past few years. Why has this strengthening happened? There are a couple of clear macro themes. A weaker US dollar overall has played an important role. After a period of broad dollar strength, markets have started to price a more balanced outlook for Fed policy, reducing upward pressure on the greenback and making carry-driven emerging market currencies like the ZAR more attractive. This has helped the rand find support and trend lower in USD-ZAR terms. Improved global risk appetite has also helped. When risk sentiment improves, capital tends to flow back into higher-yielding emerging markets, supporting both equity markets and currencies. In addition, commodity prices being firm supports the South African terms of trade, especially for metals such as platinum and gold, which bolster foreign exchange flows and help underpin its foreign currency. Recent commodity strength has been a supporting backdrop. While the rand's recent performance is constructive, it's important to note that much of the move reflects external factors, dollar weakness and global sentiment, rather than a sudden broad-based improvement in South African domestic fundamentals. Now turning to South African equities. Over the same 3-month period, the JSE All Share Index has delivered a positive return of close to plus 9 to 10%, ending the period just over 119,000 on the index. Local equities have now put in strong gains, not just over the last quarter, but across 2025 more broadly, with the All Share up materially year to date and outperforming many developed markets on a rand terms basis. Some of this performance can be attributed to several key drivers. Corporate earnings strength, particularly within sectors such as financials and resources, has helped underpin index performance, while performance has been mixed across constituents. Cyclical and commodity-linked companies have generally provided support. Improving investor confidence as macroeconomic risks, such as fiscal discipline and inflation trajectories, have become better defined, also supports risk assets like equities. Foreign inflows have begun to tip into the South African market after a period of outflows, as some global investors reassess valuations and yield opportunities in emerging markets. To summarize, the combination of a firmer exchange rate and rising equity markets over the last month suggests a more optimistic risk environment for South Africa's financial assets, but one that remains vulnerable to shifts in global policy, dollar strength, and domestic economic indicators. As we move into the next month, we'll continue to keep an eye on central bank decisions, commodity price trends, global risk sentiment, and domestic growth data, all of which remain key to both ZAR and the JSE's trajectory. Now looking at the US dollar index or DXY. Over the past month, the dollar has softened, briefly breaking lower before stabilizing around the 97 to 98 level. This marks a meaningful pullback from the stronger levels we saw late last year. The key driver here has been changing expectations around its interest rates. Markets have become more confident that the Federal Reserve is closer to the end of its hiking cycle and potentially moving towards rate cuts later this year if inflation continues to cool. As a result, as real yields have eased, the dollar has lost some of its interest rate advantage, and global investors have been more willing to rotate capital into risk assets and emerging markets. This softer dollar backdrop has been a tailwind for global equities, commodities, and emerging market currencies, including the rand. Turning to the US equity market represented here by the S&P 500. Over the past month, the S&P 500 has remained resilient, trading near record highs despite some volatility. The index has paused at elevated levels rather than selling off sharply, which is an important signal. What's driving this? Firstly, corporate earnings, especially from large technology and AI-linked companies, have generally met or exceeded expectations. That has helped justify higher valuations. Secondly, markets are still pricing in a soft landing scenario, whereas growth slows, inflation moderates, but a recession is avoided. That's a very equity-friendly outcome. Finally, the expectation that rates have peaked has supported equity multiples, even as investors become more selective and sensitive to valuation. So while gains may be slower from here, the tone of the US market remains constructive rather than defensive. Lastly, let's look at Europe via the Euro Stoxx 50. European equities have actually been one of the quieter outperformers over the past month, continuing to grind higher and pushing toward recent highs. There are a few reasons for this. Valuations in Europe remain more attractive than in the US, drawing incremental capital flows. Inflation in Europe has continued to moderate, allowing the ECB to shift toward a more neutral policy stance. Energy prices have remained relatively contained, reducing one of the key macro risks Europe faced previously. While European growth is still modest, the risk outlook has improved, and that has been enough to support equity markets. Let's look at gold. Over the past 3 months, gold has been in a clear upward trend, recently pushing to new highs before pulling back slightly and stabilizing around current levels. This move hasn't been random. It reflects a combination of macro and behavioral forces. Firstly, real interest rates have softened, as markets become more confident that use creep. Interest rates are near their peak. The opportunity cost of holding gold, which yields nothing, declines. That's historically supportive for gold prices. Secondly, gold continues to benefit from its role as a store of value and portfolio hedge. Even though equity markets are strong, investors are still carrying structural concerns around inflation persistence, geopolitical risk, and long-term debt levels. Gold tends to perform well in exactly that kind of environment. Finally, central bank demand, particularly from emerging markets, has remained strong. This has added a steady underlying bid to the gold market that is less sensitive to short-term price fluctuations. The recent pullback we see on the chart looks more like profit-taking after a strong run, rather than a change in trend. Now let's look at Brent crude oil. Oil has been far more volatile over the past 3 months. After trading lower into December, prices have rebounded sharply, moving back toward the upper end of the recent range. This rebound is important because oil sits right at the intersection of inflation, growth, and geopolitics. On the supply side, OPEC discipline has been a key factor. Ongoing production management has limited excess supply, helping prices recover once demand stabilized. On the demand side, markets are balancing two forces: slowing growth expectations in some developed economies versus resilient demand from the US and parts of Asia. Add to that geopolitical risk in key energy regions, and oil prices have regained a risk premium over the past month. For investors and policymakers, this matters because oil feeds directly into inflation expectations. Rising oil prices can slow the pace at which inflation falls, which in turn influences central bank decisions. To conclude, the past month has been characterized by a more constructive risk environment, supported by a softer US dollar resilient equity markets and firm commodity prices. At the same time, the underlying drivers remain finely balanced. Central bank policy inflation dynamics, global growth expectations, and geopolitical risks continue to interact in ways that can shift market conditions quickly. As always, the focus is less on predicting outcomes and more on understanding the forces at work and how they are evolving over time. We'll revisit these themes as the data unfolds in the month ahead.